Bitcoin is blasting past $118,000, marking a stunning new all-time high for 2025. But while Bitcoin rockets to record territory, the rest of the crypto market seems eerily frozen. Altcoins aren't surging. No broad-based mania. No sweeping rotation. So what's really going on? Welcome to FluxFolio Finance. Today, we're pulling back the curtain on the biggest question in crypto right now. Why is Bitcoin soaring while altcoins are stuck in neutral? We'll dig into the data behind this divergence, from spot ETF inflows that are swallowing up BTC supply, to stablecoin reserves that act like dry powder waiting to deploy, to Bitcoin dominance metrics that tell us exactly how capital is moving. We'll also look at the structural differences between this cycle and 2021's alt-season mania, and what signals to watch for the next big rotation into Ethereum and altcoins. So stay tuned, because if you want to know not just where crypto is today, but where it's heading next, you're in the right place. Let's start with Bitcoin itself, the clear star of this cycle so far. In 2025 alone, BTC is up over 25%, breaking past $118,000 and entering true price discovery. This rally has been supercharged by a $1 billion short squeeze in early July, which forced leveraged sellers to buy back BTC at any price, accelerating the move past key resistance levels. But it's not just short-term momentum. The real story is institutional demand. Spot Bitcoin ETFs have seen historic inflows this year, over $51 billion so far in 2025. On July 10th alone, net daily inflows topped $1,018 billion, a record for any crypto product. BlackRock's IBIT, the iShares Bitcoin Trust, became the fastest ETF in history to cross $80 billion in assets under management, achieving it in just 374 days. That pace outstrips every bond or stock ETF launch ever recorded. Institutions aren't just trading Bitcoin anymore. They're holding it in regulated, custodial structures designed to fit neatly into balance sheets and 401ks. And prominent voices like Rick Edelman are calling crypto a once-in-a-generation allocation opportunity, advising investors to consider 10% to 40% allocations in diversified portfolios. It's a new era. This isn't 2017's retail-driven hype. This is BlackRock, Fidelity, Franklin Templeton, and pension funds systematically buying Bitcoin in massive, transparent, audited blocks. That scale of demand is more than enough to drive price higher, while leaving much of the broader crypto market waiting for its turn. So why do these ETFs matter so much? Because they're not just exposure on paper. Spot Bitcoin ETFs actually hold real Bitcoin, custodied in cold storage with institutions like Coinbase, BitGo, or Fidelity. When an investor buys an ETF share, an authorized participant typically buys BTC on the open market to back it. Those coins leave exchange circulation and sit in vaults. That reduces market float, tightens supply, and creates sustained upward price pressure. At present, spot Bitcoin ETFs globally hold over 1.2 million BTC, worth more than $148 billion. The average expense ratio hovers around 0.92%, making them cheap enough for large investors while still generating profits for issuers. For comparison, Ethereum ETFs are much smaller, holding around $405 billion total. That disparity matters. Institutions are primarily allocating to Bitcoin first, drawn by its liquidity, brand recognition, and regulatory clarity. These ETFs are built for pension funds, endowments, and wealth managers who need easy, auditable, insured crypto exposure that satisfies compliance teams. And while that's a bullish force for Bitcoin, it also explains why capital isn't rotating broadly yet. The structure of ETF investing channels institutional money almost exclusively into BTC and, to a lesser extent, ETH. Altcoins. They're not in the portfolio models yet. At least, not until those ETF products arrive. But ETFs aren't the only elephant in the room. Let's talk about stablecoins, the silent whales of the crypto economy. As of mid-2025, the total stablecoin market cap sits around $254 to $255 billion. What does that mean? It's essentially the total amount of tokenized dollar liquidity sloshing around on-chain. Think of it as dry powder, capital waiting to be deployed into crypto assets. Breakdown by the big players: USDT Tether, $159 billion, USDC Circle, $62 billion, others, DAI, FDUSD, PYUSD, USDE, $33 billion. But it gets even more interesting when you look at behavior. Binance's stablecoin reserves dropped by over $31 billion in recent months, indicating capital has already started moving into spot BTC purchases and derivatives, fueling price momentum. Meanwhile, Tether's own balance sheet is a macro story unto itself. They hold over $98 billion in US Treasury bills, making Tether one of the world's largest private holders of American debt. That means stablecoin demand isn't just a crypto signal, it influences global yields. And as these stablecoin giants grow, they accumulate massive pools of fiat collateral ready to rotate into risk assets. Today, much of that flow is going straight into BTC and ETH ETFs. But when Bitcoin cools off and consolidates, all that stablecoin supply is potential fuel for altcoins. In every cycle before, stablecoin surges have been an early indicator that capital is ready to rotate. And the powder is there. It's just waiting for the right moment. Let's talk market structure. If you want to understand when altcoins might finally join the party, you need to watch Bitcoin dominance. BTCAD is the metric tracking Bitcoin's share of total crypto market cap. In early July 2025, BTCD dropped slightly, from about 66% down to around 64.5%, as altcoins began seeing small inflows. Meanwhile, the altcoin market cap, what traders call Total 2, pushed back above $1.2 trillion for the first time in months. Those are signs of life, but they're not yet signs of full-blown rotation. In 2021's legendary alt season, Bitcoin dominance collapsed from around 70% all the way to 38%, unleashing a frenzy of capital into Ethereum, DeFi tokens, NFTs, and meme coins. Today, the dominance metric remains too high to signal that kind of mass rotation. On-chain flows show the same story. Funds are still disproportionately moving into BTC and ETH, while smaller cap tokens see choppy, fragmented inflows. The lesson? For alt season to truly ignite, Bitcoin's dominance needs to drop well below 60%, ideally closer to the mid-50s. Until that happens, these smaller moves are just that, minor rotations within a Bitcoin-led market. So why is this cycle different from 2021's alt season? Let's go back. The 2021 bull run was fueled by retail mania. DeFi exploded, NFT sales hit billions monthly, and there was a clear, rapid cycle of capital rotation. BTC would pump, then stall, ETH would surge, and finally the capital would cascade into mid- and small-cap altcoins. Retail investors were using stimulus checks, trading apps, and DeFi protocols with abandon. Today's environment is dramatically different. First, institutional ETF inflows have become the main event. Bitcoin is being systematically accumulated and locked in cold storage. Ethereum is getting its own ETFs, but at a fraction of the scale. And while some altcoin ETFs are proposed, like Solana, XRP, or Kronos, none have been approved yet. Meanwhile, the token landscape is oversaturated. There are now over 42 million tokens listed across chains, fragmenting attention and liquidity. Instead of a single dominant narrative like DeFi summer or NFT mania, we see micro-rotations, AI tokens, gaming tokens, meme coins. These mini-bubbles can't absorb institutional-scale capital the same way. Add to that tighter macro conditions, no Fed rate cuts yet, still elevated borrowing costs, and you see why speculative rotation is so much slower. Institutions want compliance-friendly exposure. And right now, that's BTC and to a smaller extent, ETH. The cycle has changed. Retail might eventually return, but it won't look like 2021. So with all that in mind, why exactly hasn't alt season arrived yet? First, institutional capital is overwhelmingly locked in BTC and ETH ETFs. These products have regulatory approval, secure custody, and clear liquidity. For asset managers, that's an easy sell. For altcoins? Not yet. Second, macro conditions remain cautious. The Federal Reserve hasn't cut rates yet. Monetary policy is still tight. That keeps risk appetite in check, especially for volatile, smaller-cap assets. Third, even with recent small dips in BTC dominance, the altcoin season index, widely tracked by traders, still sits below 50. Historically, alt season doesn't truly kick off until that index moves well above 75. Fourth, SEC approvals for spot altcoin ETFs covering coins like Solana, XRP, and others are still pending. Until those launch, there's no comparable institutional pipeline to drive structured capital into alts. And finally, retail sentiment remains cautious. After the brutal bear market of 2022 to 2023, many retail traders are wary. On-chain data shows fewer new wallets interacting with DeFi and meme tokens compared to previous cycles. Even when narratives do gain traction, they're fragmented. AI tokens, gaming, niche layer 2s, yield-bearing stablecoins. These sectoral bursts aren't strong enough yet to lift the entire altcoin market. Bottom line, until these hurdles clear, capital will stay concentrated in Bitcoin and Ethereum, leaving altcoins waiting for their moment in the sun. So what could change this picture? First, Bitcoin needs to consolidate or experience a mild pullback, say 10 to 15%. When Bitcoin stabilizes, historically, capital starts rotating to higher risk assets. Second, watch the ETH-BTC ratio. Ethereum outperforming Bitcoin would be a strong signal of rotation. Coupled with growing institutional interest in ETH ETFs, already seeing hundreds of millions in inflows, it's a key metric for early alt-season signals. Third, regulatory green lights. The SEC is reviewing multiple spot altcoin ETF applications. If approvals come for products covering Solana, XRP, Kronos, and others, that could open the door to billions in institutional capital moving beyond BTC and ETH. Fourth, stablecoin flows. We're seeing stablecoin supply already topping $255 billion. Watch for growth on exchanges like Binance, where reserve balances can signal readiness to deploy into alts. Fifth, macro catalysts. A pivot by the Federal Reserve, a move toward rate cuts or new stimulus would increase global liquidity and risk appetite, unlocking capital that's currently on the sidelines. Finally, on-chain velocity. More stable coins moving between wallets, rising DeFi TVLs, and growing trading volumes in altcoin pairs would be the telltale signs of rotation heating up. If these ingredients align, alt season could ignite rapidly, following the familiar cycle. BTC leads, ETH catches up, and then capital spills into mid and small cap tokens. But it needs those triggers to fall into place. So how can you track it? Here's your FluxFolio Finance playbook. Monitor stablecoin balances on exchanges. A surge means new buying power is waiting to deploy. Guess and track BTC dominance, BTCD. A move below 60% is historically a reliable signal that altcoin rotations are beginning in earnest. And follow institutional ETF flows. Use trackers like BitBo and The Block to see where money is going daily. Watch for narrative priming. AI tokens, meme coin volumes, gaming, and sector TVLs can indicate early sector-specific mini-rotations before a broader rally. Use the Altcoin Season Index and TradingView/CMC mobile charts. These tools aggregate market signals into easy-to-watch indicators. Focus on quality. Highlight assets with real fundamentals. ETH as the clear Layer 1 institutional bet, SOL for speed and ecosystem growth, ARB for Layer 2 scaling, plus select niche meme coins with strong communities. This isn't about chasing every hype pump, it's about understanding when capital is rotating and positioning ahead of the crowd. In conclusion, Bitcoin's rally is no accident. It's fueled by ETFs, stablecoin liquidity, and an unprecedented flood of institutional capital. But altseason? That story isn't written yet. It needs BTC to consolidate, stablecoin balances to deploy, and dominance to fall before the rotation can truly begin. Stay ahead of the next big move. Hit subscribe for weekly deep dives into institutional flows, market dominance, and the evolving crypto cycle. And don't miss our next episode, Altcoin ETF approvals and real-time capital rotations, where we'll break down exactly how to spot the early signs of the next alt season. Thanks for watching FluxFolio Finance.